Today is Monday, April the 4th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, ADMIS Vice President of Grain Research, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, let's start with the grain markets this morning. What was the reaction to the March 31st USDA acreage and stocks report?
USDA reports are always interesting, and in 2022, every report's going to be critical. The trade thought that we would see less corn acres and more bean and wheat acres. What we got was a lot more bean acres, a lot less corn acres, and lower spring wheat acres. The market reaction to the beans was quick, volatile, and sharply lower. By the end of the day, we also had corn and wheat lower as the markets tried to take off some war premium. I think the fact that the corn acres are down put these corn at new contract highs. Beans are trying to come back from their recent lows because of what could be more China demand. The wheat market is back today, putting war premium on.
See, what do you think are the three most important issues that will affect grain prices this month?
Well, it's April, and so number one will be weather. And we're looking at the possibility of dry weather in the southern plains and Midwest this year, plus too much wet weather in the eastern half of the U.S., including the Delta and the Southeast. So I think that the weather market's going to be positive. Number two is China. They have a zero tolerance in COVID cases, and you're seeing a drawdown in demand for imports of energy and commodities. We just don't know how long that's going to last. They announced a big sale of U.S. corn to China. And I think that's a reflection that probably Ukraine will not be shipping as much corn as the market had anticipated. And then I think number three has to do with money flow and with ETFs coming in and buying grains, buying corn, moving some money around. And I think that inflation, it will continue to be supportive in the commodity market. So I think weather's friendly. I think that China is a negative right now. And I think inflation is a positive.
Yeah, let's stay with the inflation theme. Steve, what is the managed fund position and what impact has the energy market and higher commodity prices in general had on the grain price action?
We're bringing new money into the grain market. The index funds have a record long corn, soybean, wheat, soybean meal, and soybean oil position. Last week, the managed funds took a little profits in their record position for this time of year, but I think they're going to put all that back on. So as the spring and summer progresses, I would expect more money to come in on the long side from both the managed funds and also from the index funds. And I think that leaves the commercial being short. And so I think that that'll be one risk that the market has going into this marketplace. But I think the fund positions right now is a positive to the marketplace.
Alan, let's look at the financial markets. What will the minutes from the March 16th Federal Open Market Committee meeting likely reveal when they're released on Wednesday?
Well, most likely, of course, the Fed will talk about inflation and their desire to rein that in. I think they'll probably talk about the need to raise interest rates. I think there may be some strong hints that the Fed at the May 4th meeting could raise rates by 50 basis points rather than 25 basis points. In fact, there's about a 75% probability that we will see a 50 basis point hike. So I think the Fed is going to try to instill a belief that they are serious, and I think they are, to control inflation, and they're going to meet that with a very aggressive stance on interest rate policies.
And it seems that some of the recent volatility in the stock market has been reduced. Why and what direction do you think the market will move heading into the summer months here in the U.S.?
Well, I think there's some technical aspects that seem to be a bit more friendly. We are above downtrend lines in all of the major stock index features. Looks like there may be some hopes for some success in peace talks. But countering that, we have earnings that are likely to be weaker going forward. It also looks like GDP will probably not be as strong as what we saw in the fourth quarter. But I think in advance of the Fed meeting, as traders do not focus so much on the Fed, there will be a tendency to drift a little bit higher. And in fact, the future is performing well in spite of plenty of reasons not to. So in advance of the Fed meeting, there may be a possibility of further advances in the stock index futures.
Alan, looking at the interest rates, which one of the futures markets should be sold?
Well, first of all, I think they all should across the curve. The yield curve, as it's inverting even more, suggests that it's the front end of the curve futures that will probably come under the most pressure. But I think the entire curve, even the 30-year bonds, so I think they all should be sold, from the Fed funds futures to the Eurodollar futures, 2-year notes. I would focus more on those, but even the 30-year bonds, I think, will probably work lower. So I think the whole curve should be sold.
Thank you, Alan, and thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.